In a recent video, I discussed how to estimate the relative attractiveness of T-bills compared to gold and silver compared to gold using the past 45 years of market data as a guide. I discussed platinum and palladium as a side note, but I didn't have enough data on either of them to put together any reliable valuation framework. Since that time, I've been able to piece together enough historic data for both metals to develop statistical models to use as a reference to gauge the attractiveness of each metal at current market prices. In this video, I will present the models and will comment on current valuations relative to gold. First, let me refresh everybody's memory on how the model of silver was developed. In this graph, I'm showing annualized long-term returns of silver relative to gold using each of the past possible 10-year windows of history for the past 45 years. Each of these returns is shown as a circle on the graph. On the horizontal axis, I list the gold to silver ratio at the start of the 10-year time window. On the vertical axis is the annualized return of silver relative to gold. A positive annualized return means that silver outperformed gold. A negative annualized return means that gold outperformed silver. And the magnitude of the number is the annual rate of outperformance or underperformance. As can be seen, the data is reasonably linear, and a line fit to the data intercepts the y-axis at a gold to silver ratio of 63.3. The significance of this is that historically, if the ratio of the gold to silver price was greater than 63.3, then silver would outperform gold over the following 10 years, and if it was less than 63.3, then gold would be a better metal to buy. Some summary statistics run on my regression model give an R-squared value of 69%, meaning that 69% of the variability in silver returns could be explained simply through the gold to silver ratio. The other 31% of the variability of returns relative to gold was due to other factors. The F statistic was 472, while the value that would be required for 99% statistical significance was 4.65. Given the number of degrees of freedom available, of course. In other words, the model was highly statistically significant. So how well did the model actually predict returns if it were to backtest the data? Here's the answer. Going back 45 years and looking at every 10-year window of time, we can plot the actual annual return of silver versus gold and compare it against the model prediction. Note that the actual data stops in the year 2004 for the simple reason that we don't yet know what the 10-year forward annualized returns will be from that point forward. We do, however, know what the model predicts, and so I've included the predictions in green. Currently, silver's performance going forward is predicted to be roughly on par with gold's. We can see on this chart that the simple linear model does a fairly good job of matching the actual data. We can also see that the model had a sharp dip in early 2011, indicating that it was a good time to swap some silver for gold. And it did turn out to be a pretty good time to do that. So what about the other white metals? We can do exactly the same exercise with platinum now that I have enough data. Again, we can see that the annualized 10-year returns of platinum relative to gold is roughly linear in the gold to platinum ratio. The data seems to cross the y-axis at a gold to platinum ratio of 0.8. This would indicate that platinum is fairly valued when gold's price is about 80% that of platinum's. A higher gold to platinum ratio would favor platinum performing better over the following 10-year period, and a lower ratio would mean that gold would probably outperform. The statistics of the regression are really quite good. An R-squared of 75% means that 75% of the long-term performance of platinum relative to gold can be explained simply through the gold to platinum ratio. The F value is 140 times what would be required for 99% statistical significance, confirming that this model is highly significant. Okay, so how did it actually predict? Well, let's take a look. Here's the comparison of model predictions versus actual relative returns for each 10-year window of time going back 45 years. It should be noted that the predictions are really quite good. There are very few financial valuation models that I have seen that can predict this well. Most of the trend in the data is reflected. All that was needed at each point in time was the platinum price relative to the gold price. Again, we don't have actual performance data beyond 2004, but we can still plot the predictions. Currently, platinum is expected to outperform gold by 1% or 2 per year. So let's take a look at palladium now. Palladium, it seems, is quite a bit more erratic than silver or platinum, and so there is much more scatter in the data. Still, we can regress a model that is statistically significant and descriptive enough to be useful. Note that a line fit to the data has an R-squared value of 49%, meaning that only half of the variability in palladium returns relative to gold can be explained from the starting gold to palladium price ratio. The other half is due to other factors. So the model is only partially useful. Still, it can give us a rough idea of what the fair ratio of prices is. In this case, it appears to be 2.4. So most of the time, when the ratio of gold's price to palladium's was greater than 2.4, it would mean good things for palladium. If the ratio was under 2.4, it would mean that the probabilities favored gold. The regression is still quite statistically significant, but not nearly as much so as that for silver or platinum. So let's see how well this model predicted performance in the past. Well, the answer is not terribly well in terms of predicting the magnitude of the performance relative to gold. However, it did quite well at predicting when palladium would do better than gold and when it would do worse. Note that the model would have the investor favoring palladium from 1977 through 1997, and favoring gold from 1997 to 2008. From a long-term investing perspective, this was exactly the right thing to do. Sure, the investor would have missed out of the palladium bubble from 1988 to 1990, but the investor also would have missed the crash back down to earth as well. On the whole, the model would have done a nice job of keeping the investor in the right metal at the right time. And so, if we take a look at the current price levels, we can predict how platinum and palladium are likely to perform going forward relative to gold. I've placed a dot on the graph indicating what the expected relative performances are likely to be. Platinum is expected to outperform gold over the next 10 years at a rate of about 1.5% per year. So after 10 years, the total outperformance will likely be roughly 16% in total. Palladium, on the other hand, is likely to underperform gold by about 5% per year. So the investor who chooses gold instead of palladium is likely to have 63% more wealth at the end of a 10-year period. But nothing in life is certain. I've drawn an oval on the graph to encircle one standard deviation from expected returns. About 68% of the possible outcomes are expected to lie within this oval. We can see that there is much less certainty associated with the prediction of palladium returns relative to gold. So there is a small chance that palladium will outperform gold over the long term. There's a fairly large chance that platinum will outperform gold. But again, nothing in life is certain, and so an allocation to more than one single metal is wise. At present, it looks like gold, silver, and platinum are good places to be. Palladium appears to be fairly richly valued right now, when the past is taken into account.